Okay, I want to believe you guys can see my screen now, right?
Yes.
Okay, well done. Good evening. Tonight we'll be looking at company income tax, just like just as since we are done with company capital allowance. Company income tax is also one of the important topics we'll be looking at in taxation. And one thing about company income tax is you cannot just do without it. You cannot do without it. It's cut across almost everything we'll be doing in taxation. Even when you get to advanced tax, everything you will be doing still revolve around company income tax. So a thorough understanding of it now will actually help and aid you in making your tax journey easy. So what is company income tax all about? First thing first, company income tax. Company income tax is um is prescribed in the Company Income Tax Act Cap C-21 LFN 2004. But there has been a lot of amendment to this act since that 2004. We've had amendment to the Company Income Tax Act itself, which is the CITA, and we've had amendment to it that came through the Revised Finance Act. And you know, we have Finance Act of 2019, Revised Finance Act 2020, 2021, 2022, 2023. Before we now have this ultimate revision that is coming to the Tax Act, that now we will no longer be having company income tax act separated from personal income tax act, separated from capital gain tax act. What we now have is Nigeria Tax Act that will encompass
Okay.
everything. But for the sake of this diet and this class, we are still looking at the provisions of Company Income Tax Act as well as the amendment that come to it from what's it called? From
Next year.
from our Finance Act and Revised Finance Act. So now, who administers for company income tax? It is the Federal Inland Revenue Service. It is the Federal Inland Revenue Service Board are the ones that administer, they are the relevant tax authority, and they carry out that function through the Federal Inland Revenue Service, the agency, that's their agent. Now, what are those that are chargeable to company income tax? Those that are chargeable to company income tax are companies. Companies. And in what name do we charge them to tax? We either charge companies to company income tax in their own name. That is, if we say DSA Limited now, DSA Limited can be charged to tax in its own name. Say DSA Limited is paying tax. Or we can charge it to tax in the name of a principal officer or an agent or an attorney. Can also do that. Can charge it to tax in the name of a principal agent or an attorney. Then the last way we can charge company income tax to tax is what? Is in the name of a receiver or a liquidator. In the name of a receiver or a liquidator. So maybe the company is in receivership or liquidatorship. The company is in receivership or liquidatorship. The company is already winding down and the assets have been transferred to a receiver or liquidator. They will be the one to pay they will be the one to pay the profit on any profit that is accruing to a company. Either it is derived from their trade or either it is derived from, it is brought into, or received in Nigeria from the following sources. What do we mean? Either the income is derived from Nigeria, it is brought into Nigeria, or it is received in Nigeria, whichever of the three. So far it is coming from any of the following sources, it will be chargeable to company income tax. One is profit or income from any trade or business, which is the main the main source of income for companies. The next one is dividend, interest, discount charges or royalties, as well as rent also. Gain from acquisition or disposal of short-term money instruments, except where they are what? Government instruments. Except where they are government instruments. Except where they are government instruments. Then um, fees and dues and allowances for services rendered. So, in some cases, a company might render management or technical services to another company, maybe management, consultancy, and the likes. Fees they are getting from it are subjected to company income tax. Then rent premium from property letting. If they rent out their property, the income is also subjected to company income tax. Are we following?
Yes, sir.
Are we following?
Yes, sir. Yes, sir. We're with you, sir.
Yes, yes, yes. Go ahead, sir. Yes, sir.
Please be asking me o. Kó má lọ jẹ́ pé mo bára mi sọ̀rọ̀ o. Okay, annual return. Annual return. What do we mean by annual return? When we say annual return is just the submission of documents to the relevant tax authority. To the relevant tax authority for cross-checking of their assessment. In Nigeria, we practice a self-assessment basis. That is, the taxpayer by themselves will determine what should be their tax liability. They will do the calculation themselves and do the payment. However, when you are done doing that, you have to now submit your document to the relevant tax authority for them to check if what you have done is right or wrong. So that's what we call filing of annual returns. Filing of annual returns. Filing of annual returns just have to do with submitting necessary documents to the relevant tax authority. And what are the contents of an annual return? We have one, an audited financial statement. That is why auditing is very essential. And that's why you see companies that they always make sure their account is audited early enough so that they can use it to file when the time is right. Audited financial statement is one of the contents of annual return. However, where a company does not have audited financial statement, they can also file with other types of financial statements, be it management account or unaudited account. But they must have taken permission from the Federal Inland Revenue Service before they can do that. That is, they have to write, if they don't have audited financial statement, they have to write to the Federal Inland Revenue Service that, we don't have this, we want to take permission to use this. Take for instance now, the Companies and Allied Matters Act, CAMA, of 2020 has now exempted small and medium enterprises from mandatory audits. Before, all companies must engage an external auditor to audit their financial statement. But the CAMA Act of 2020 has negated that no, it's not a must for them to audit their financials because they don't even have enough. So if they don't have enough, how do they audit? How will they be able to audit? So they don't have enough money to pay. So it will just increase their burden. So they are not mandated. So if they don't want to audit, they can submit another type of report. So that's just that.
Okay.
The next is the tax computation. How we go about that is what we want to look at in today's class. How we go about the tax computation is what we want to look at in today's class. The next one is the capital allowance computation. That's why you will see that we spent more time on capital allowance computation. It is one critical aspect. It is one important aspect when it comes to filing annual returns. It is one of those things you submit. Next one is a copy of duly completed assessment form. A copy of duly completed assessment form. So in time past, when we do paper filing, you have to get a copy of the assessment form from the relevant tax authority, fill it with the necessary details. But now that we do e-filing, we file online, the form you are supposed to fill is that place where you put your details. Once you are putting the details of your company, you are already filling the form. The last one is an undertaking that the information contained in the annual return is true, and that must be signed by the director or the company secretary. So regarding this undertaking, so we, as I said before, when we do paper filing, there is a section for us there where the principal officer have to write their name and sign that, oh yes, all of what we have put together as filing of annual returns is true. But now it is just a click of a button in the filing platform. Just click that yes, you agree that all what you have supplied is true. And if they later find out is not true, then that officer will be the one will be liable for it. Will be liable for it. So when it's the time of filing is done within 6 months. Within 6 months from the end of the financial year. Note, we did not say from the year of assessment, though. Within 6 months from the end of the financial year. From the end of the financial year. It must be done within 6 months from the end of the financial year. So what does that mean? It simply means if a company ends their account 31 December of a year, before 30th June of the following year, they must have filed their returns. And that's why you see that the first 6 months of the year is always a busy period. For auditors and tax consultants, because most companies end their financial statement on 31 December. However, let's say a company end their whole financial statement 31 March now, 31 March 2025. Even though that account will be assessed for 2026 year of assessment, they must pay the tax and file the returns on or before 30th September 2025 also, because that's the 6 months period that they have to file. But they are filing for 2026 year of assessment. Is that clear?
All right. Yes, sir.
Yeah.
Yes, it
But
is.
where a company is just commencing operation, they are to file at the earliest of 18 months from the date of commencement, or 6 months after the end of the first account. Please, that person should kindly mute their mic. I'm hearing my voice back, so it somehow disrupts the record. Okay, thank you. So as I was saying, if a company is just commencing, their first filing will be earlier of either 6 months from the end of their first account, or 18 months from the date of commencement, whichever comes first. So invariably, we are saying that company must file within 18 months from the date of commencement. But if they have ended their first financial statement and 6 months from that day comes before the 18 months, then they have to what? Then they have to file their account on the basis of that 6 months. So whichever comes first is the one we what? Is the one we will go for. Are we getting it?
Yes,
Are
sir.
we getting it?
Yes, sir.
Yes, sir.
Okay. So the next thing is, what's the penalty for late filing? The penalty for late filing is 25,000 in the first month and 5,000 for every month. Sorry, I think I need to correct that. I will update you on the group chat if there is any change to that. I will update that. I will update that. So, but there is penalty for late filing, and penalty for late filing differs from penalty from what? Penalty from late um penalty from late payment. Late payment is another offense on its own. Late payment is an offense. Late filing is an offense. They are different offenses. So if you pay, you don't file, is an offense. If you file, you don't pay, is an offense. So you have to do both. You have to make sure you pay and you have to make sure you file. There are other returns
Fine.
that some specific companies are to file that are different. Those five we mentioned are generic to all companies. But like banks now, they have other specific things they have to file. Capital market operator have other things they have to file. But that's not our main focus for tonight. Now, what is the company income tax rate? The company income tax rate, according to the Finance Act, is that what? We now classify companies into three categories based on their turnover. We have small companies, we have medium companies, and we have large companies. Small
Okay.
companies are those with turnover of 0 to 25 million. 0 to 25 million. Their tax rate is 0%. 0%. Medium company, theirs is what? 25 million to 100 million. Above 25 million, but below 100 million. So, what's their own tax rate? 20%. Why for large company? For large company, the tax rate is what? The tax rate is 30%.
30%.
Their own turnover is above 100 million. Above 100 million. Yeah. So that is that. But the fact that the tax rate for small companies is 0% does not mean they will not file returns. They must file returns. Either you have tax liability or not, you must still file returns. So what do we have? What are we saying next? Yeah. The next we will discussing will be computation of the tax liability, and that's where our major work is. Computation of the tax liability. How do we determine the tax liability? So in determining the tax liability,
Hello, sir.
I'm with you. So
Okay.
sorry about that. Yeah. So
Okay.
like I said, our main focus will be on computation of the tax. How do we compute company income tax? Company income tax is computed on four bases. One is on chargeable income. Some people call it chargeable income or chargeable profit, sorry. Some also call it taxable income, while some call it total income. Sorry, profit. Let's use profit since we are talking of company here. Profit. So we compute it on this basis, which is the normal basis. We also compute CIT on dividend basis. We also compute CIT on turnover basis. And we compute CIT on minimum tax basis. basis. Now, what does all of this mean? Computing CIT on chargeable income basis will have something like this: DSA limited, DSA limited, DSA limited, computation of tax liability for relevant year of assessment. Computation of tax liability for relevant year of assessment. So we actually have two methods. We actually have two methods. We have the direct method and the indirect method. And the indirect method. The direct method, we don't usually use that. For direct method, we will take taxable income less allowable expenses, but it is stressful. So we mostly use the indirect method because they would have given us the account in the question. So we'll just work with the indirect method to determine our tax liability. And how does that work? We start with the net profit of the business. So this net profit, based on accounting principle, the net profit would have been what? The total income less all expenses. However, for taxation purpose, we have what we call disallowable expenses. What are disallowable expenses? Disallowable expenses are those expenses that are what? They are those expenses that are what is it called? They are those expenses that are not permitted by the tax law. They are not permitted. We are not saying the company cannot spend it, but when we are computing your tax liability, we will not take it as an expense. We will not treat it as an expense. That means you have to pay tax on it, even though you've incurred those expenses. So we had back our disallowable expenses. So basically, disallowable expenses are what? They are those expenses that are not wholly, reasonably, exclusively and necessarily for the business. Wholly, reasonably, exclusively and necessarily for the business. What do we mean by wholly? Wholly simply means an expense being incurred by a company in its entirety. Sorry, 1 minute. Okay, so wholly, when we say an expense is wholly incurred by an entity, or when we say wholly, we mean the entity is paying for the whole expense. Now, if we say, okay, we incur, let's assume now DSA have to buy, let's say they have to pay for a Google Meet subscription for them to hold virtual classes. Now, after paying for that Google Meet, well, when they wanted to pay for that Google Meet subscription, DSA doesn't have enough money. Mr. David now say, okay, let me pay part of it. So DSA only have 5,000. Mr. David say, okay, let me put the remaining 5,000. Only 5,000 that was paid by DSA will be allowable. The remaining portion that wasn't paid by DSA will not be allowable. That's what Oli is saying. Reasonably is saying, does that expense, does it fall within, is it let me say, is it needed? Don't let me use needed. Is it within the means of what we need? Now, if we say, okay, let's look at it now. We want to do virtual class. We now look at three options. We have Google Meet, where we'll pay 10,000 per month. We have Zoom, where we'll pay, let's say 40,000 per month. And we have Teams, where we'll pay 50,000 per month. The three of them will serve us in the same way. They all give us the same features. Which one is reasonable? The reasonable one is Google Meet because it's the one with the lowest cost, and it will still give us, it will still serve the same purpose others that have high cost will serve. Are we getting it? But where that smallest one cannot serve the purpose we want to actually do, then we cannot take it to be the reasonable one. No. So even if they say go ahead and do that one of 50,000, when they have a one of 10,000 they can do to serve the same purpose, then the portion that the excess of 40,000 they spend, which is not reasonable, will be disallowed. Are we getting it? Are we getting it?
Yes, sir. Yes.
The next one is exclusively. Exclusively is where the entity is the only one enjoying the benefit of that expense. If after paying for the subscription now, they now give maybe their church to be using for revival or deliverance, then the portion the church is using will be disallowed for DSA because that is not an activity of DSA. Are we getting it? Exclusively. Exclusively means the benefit of that expense must only be enjoyed. Only the portion that is being enjoyed by the entity will be allowable, and necessarily will now be, is it needed for the business? If DSA should pay for online meeting or online meeting platform now, it is necessary. But where they say we are doing online classes, so they now went to rent building and say we want to be sitting down there, no, that's not necessary. That's not necessary. Are we getting it? Or they now buy bus that they said, okay, what do you now buy bus for? It's for the, what are you doing? You are not, your students don't even come for physical class, so you can't say you want to be using bus to carry them. So that one will not be, that one will be what? It will not be necessary, and it will be disallowable. It will be disallowable. Or where they now, let's say they now buy, they do Google Meet, they still do Zoom. It is not necessary again. If you have Google Meet, there is no need for Zoom, except if maybe you are now scared that okay, there might be downtime on Google Meet that you need Zoom to augment for. But if that's not the case, then you are just wasting money. It will not be what? Allowable. Aside those ones, those four we said, there are also specific expenses that are disallowable in their own nature. One of it, the jagaban of it all, is depreciation. As we already said, capital allowance is granted in the place of depreciation. Therefore, capital allowance is disallowable. Is disallowable. Is disallowable. The next one is what? The next one is um any expenditure of capital nature. If an expenditure has a capital nature, it means it should be capitalized. I mean, it should be treated as an asset. You cannot expense it. Before we can say an expense has a capital nature, it means it will generate benefit for more than one accounting period. So you cannot expense such. You can only capitalize it and enjoy capital allowance on it. The next one is for donation. So for donation, we have two types of donation. We have general donation and special donation. For general donation is allowable, but it has four conditions it must meet for it to be allowable. Condition number one is that it must be made out of profit. You cannot be making loss and be making donation. It must be something you made out of profit. Number two is that it must not be capital in nature. It must not be capital in nature. Number three is that it must not exceed 10% of the chargeable profit. It must not exceed 10% of chargeable profit. Number four is that it must have been made to one of the bodies listed in Schedule 5 of SITA. So if you look at the last page of this material before we get to the question page, that's page 7, you will see Schedule 5 of SITA, fifth schedule of the SITA. We have bodies listed here. These bodies here, they are those bodies you can donate to, and when you make donation to all of these bodies, it will be allowable. But if your donation is not to any of these bodies, it will not be what? Allowable. It will not be allowable. So let's just take our time to go through the does not meet any of those four conditions, it will be what? Disallowable. It will be disallowable. The next one is what? Provision for doubtful debt of a general nature. When we are making general provision, we are just assuming that, okay, things may not go as we have planned. All of these people that are owing us may not pay us. So let's just use a percentage to know what they will not pay. That one will be disallowable. It will be disallowable because it doesn't have a fact or a basis. Now, the next one is income tax provision. Yes, the income tax is what we are computing for. So you cannot treat it as an expense. It is disallowable. Appropriation out of profit. Maybe you are paying dividend, you are transferring money to reserve. Those are not expenses. Rather, you are just splitting your profit to various things you want to use it for. So that is not an expense. If you have treated it as an expense, we will disallow it. Fines and penalties. The essence of fines and penalties is for you to feel the impact of the wrongdoing. So we cannot also allow it for tax purpose. We cannot allow it for tax purpose. Rather, if that is allowed, you will not know the impact of the wrong you have committed. So that is that. The next one is what? Is legal expenses. For legal expenses, some are allowable, some are disallowable. I will explain the disallowable here. One is renewal of a long lease. When a lease is long, its renewal will be what? Disallowable. Its renewal will be disallowable. The next one is what? The next one is acquisition of new lease, whether it is long or short. Acquisition of a new lease, whether it is long or short. It is allowed. So the legal fee you pay to acquire a new lease, either it is long or short, it is disallowable. And we say a lease is long when it is 50 years and above. If it is below 50 years, it is short. So if you have renewal of a long lease, that is a lease of 50 years and above, is disallowable. If you are acquiring a new lease, either long or short, is disallowable. Any cost incurred in tax appeal. So where you have appealed your taxes, maybe the tax authority have raised a best of judgment assessment on you now, or maybe they've sent you a revised assessment. Now say, no, I don't agree with this. You appeal. Any legal expenses you incur in the appeal will be what? Disallowable. Either the appeal is successful or it is not. And any any legal expenses incurred in defending traffic offenses, any legal expenses you incur in defending traffic offenses is disallowable. The next one is what? Any contribution to pension fund not approved by the JTB. So pension fund contribution must be approved by the JTB. That's Joint Tax Board. Joint Tax Board is just like an amalgamation of state internal revenue services. They all come together and form a body called the Joint Tax Board. So any pension fund you are contributing to, for pension, we have employee contribution and employer contribution. Employee contribution is a deduction from their salary, while employer contribution is an additional cost to the employer. It is allowable for tax purpose. 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 It is allowable for tax purpose, but where the pension fund you are contributing to is not approved by the Joint Tax Board, then come in, please. So it will be disallowable. Preliminary expenses, those are expenses incurred before the business commence operation. It is disallowable. Then loss on sale of fixed assets is also what? Disallowable. Because Loss on sale of fixed asset is disallowable because anything on disposal of assets is what is subjected to capital gain tax, not company income tax. And moreover, loss on sale of fixed assets is not an expense because we are not paying any money for it. We are not paying any money for it. So that is that. So that is that on. So that is that on that. After disallowable expenses, with less allowable expenses omitted. Allowable expenses omitted. Don't forget, we are working with the SOFP. So all expenses has been deducted before they arrive at net profit. That's the essence of using indirect method. Now we had back the disallowable expense. Those are the ones that was charged into the account before arriving at net profit that the tax law is not permitting. But if any allowable expense was also incurred, but they did not take cognizance of it to arrive at this net profit, then we now have to deduct it. So what are our allowable expenses? Allowable expenses are expenses like what? Any interest on loan obtained for the purpose of the business. Any interest on loan. Any interest on loan obtained for the purpose of the business. It is allowable. So far the loan is used for the purpose of the business, it is what? It is allowable. But let's assume you obtain a loan now. You use 70% for the business, you use 30% for personal. Only 70% of the interest also will be allowable. The remainder will be what? Disallowable. Any contribution to pension fund approved by the joint tax board is allowable. Is allowable. If you contribute to the one that is not approved, that's the one that will be disallowable. Donations, I've already explained general donation, how it is allowable. But for special donation are those donations that are made to a fund set aside by government to meet special cases like pandemic, like natural disaster. Take for instance now, when there was explosion at Abule Ado, or when there was this gas explosion in Ibadan, and government now create a fund that okay, if you want to donate so that we can take care of the victims of this explosion or the victims of this pandemic now, during COVID now, federal government has a fund that people were donating to for them to provide palliatives. During Borno flood, people were donating to government to take care of those that are affected by it. Those funds, the donation to such fund is allowable, but it must not exceed 10%. It must not exceed 10% of what? 10% of their chargeable, of their allowable, of their adjusted profit. 10% of their adjusted profit. It must not exceed 10% of their adjusted profit. It must not anything in excess of 10% of their adjusted profit will be disallowable. Will be disallowable. The next one, the next one the next one is what? Is bad debt. Any bad debt is what? Is allowable as an expense. Bad debt is allowable because you would have charged that expense before. You would have charged the expense before. You would have charged the income before. Now that the debt is bad, it will be allowable as an expense so that it can write off, can cancel the tax you were charged on such income before. The next one, the next one will be what? Provision of doubtful debt of a specific nature. Now, what do we mean by what's it called? Provision for doubtful debt of a specific nature. Before we can create a specific provision now, before we can create a specific provision, there must have been indication that the debtor will not be able to pay. Now, what do we mean by that? Let's say we have a customer that bought from us, and we already have information that the customer has filed for bankruptcy. We already know that chances of we getting such money is slim. So we have to create a specific provision. But now, that one is allowable because it has a basis. But where it is general, no, general is disallowable because it doesn't really have a basis. Legal expenses that are allowable are expenses like retainer fee. Retainer fee is what we pay to have the services of a professional at our beck and call. Let's say a personal doctor, a personal lawyer, and the likes. Then what we pay them is retainers fee, so that we can always have their services. Then general legal advisory charges. If you engage lawyers or if you engage legal services, maybe to help you review contracts and do all sorts. It is what? It is allowable for tax purpose. The next one is what? The next one is cost of protecting or defending the business. Yes, if maybe there is an issue, you have to incur cost. In maybe there is a legal case for the business, the legal expenses paid for it is allowable. Cost of renewing a short-term lease, like we said, long-term lease. Long-term lease is what? Like we say, long-term lease, renewal of a long lease is disallowable. Renewal of a short lease is what? Is allowable. Then the next one is any reasonable entertainment expenses, provided it doesn't include cigarettes and alcoholic drinks. They are what? They are allowable. The next one is any expense that is only reasonably, necessarily, and exclusively for the business. They are all what? Allowable. After adding a disallowable expense and lessing allowable expense, we also less non-taxable income. If we have it, non-taxable income. What are non-taxable income? Non-taxable income are those income that are what? That are exempted from company income tax. Those income that are not to be subjected to company income tax. Example is what? Example is profit on disposal of asset. Profit on disposal of asset, like I said, will be subjected to capital gain tax. So it will not be subjected under company income tax. It is a non-taxable income. Another one is dividend. Dividend is treated as a franked investment income. Also on dividend, we have the various dividends that are to be exempted. Dividend that is received by way of bonus issue. Now, when we talk of bonus issue, you don't pay them the dividend. You give them additional shares at no cost. It's not as if it has no cost, but the cost is the profit you are foregoing. They will not give you the profit. So since you are not getting the money, it will also not be subjected to tax. Any dividend received from profit subjected to tax under provision of petroleum profit tax. Well, petroleum profit tax has been scrapped now. We now have it under Petroleum Industry Act. Petroleum Industry Act. So any dividend declared by a pioneer profit, a pioneer company is a company that is enjoying tax holiday. So if they declare dividend, they will also not pay tax on it. Any dividend received net of withholding tax from by a Nigerian company from another Nigerian company, it is described as a fund investment income. Are we still following? Am I communicating?
Yes, sir. Yes, sir. We are with you, sir.
Okay. When we say frank investment income, we mean income that we take withholding tax to be its final tax. We mean income that we take withholding tax to be in final tax. A good example of that income is dividend. Once a dividend is received net of withholding tax, we don't charge any tax on it again. So if we have such dividend in our account, we'll treat it as a non-taxable income. We'll treat it as a non-taxable income. So we also have dividend received from a unit trust scheme. It is disallowable. It is non-taxable, sorry. Dividend from foreign investment, provided it is received through a domiciliary account or a government approved channel. If it is brought into the country through a government approved channel, it will be what? Disallowable. It will be disallowable. Then, yeah, so that's that. Also from interest on foreign loan. If you give loan to a foreign company, the interest on it will provide based on the provision of the schedule. When we are looking at taxation of specialized business, we look at the schedule. Such income is what? Such income is disallowed, is non-taxable. Interest on export loan granted will also be exempted. Interest derived from domiciliary account, it will be exempted, and so on and so forth, and so on and so forth. Then if we have any taxable income that was initially omitted, we'll add those ones. Taxable income omitted. Taxable income omitted. If we have any, we'll add it. Then once we do all of this, we arrive at what we call adjusted profit. Adjusted profit. Now, once we have this adjusted profit, we less loss relief. Loss relief. What is loss relief? It is the deduction of losses made in the previous period, from the profit before the balance is being subjected to tax. So when company makes losses, they can only relieve it from future profit the same business makes. So where we have previous losses that has been made that they have not been able to relieve, when they now make profit, they can deduct that loss from the profit, and the remainder of the profit is now what will be subjected to tax. We call that accessible profit. After having accessible profit, we had what we call balancing charge. Remember when we were discussing balancing charge under capital allowance, we said balancing charge is added to our accessible profit to be subjected to tax. Then after adding balancing charge, we less what? We less capital allowance, and we also less balancing allowance. Balancing allowance. We less balancing allowance. So once we less these two, we arrive at what we call chargeable or taxable profit. Chargeable or taxable profit. Chargeable profit or taxable profit. Chargeable profit or taxable profit or total profit, anyone you want to call it. Then it is on this taxable or chargeable profit we now compute our CIT, depending on the what? On the applicable rate. And the rate will be based on the what? On the turnover. So either 0%, 20%, or 30%. We use it to multiply the chargeable profit to know what our CIT should be. Then we also calculate education tax. Education tax can also either be at 2%, 2.5%, or 3%, depending on the year of assessment. Depending on the year of assessment, we'll charge that. So it was 2% up to 2022 year of assessment. It is 2.5% for 2023 year of assessment and up to August 2023, which is part of 2024 year of assessment, and it is 3% from September 2023, which is 2024 year of assessment till now. But by next year, EDT will be scrapped. What we will now have is development levy, development levy. And this education tax, it is not charged on this chargeable profit. So rather, it is charged on this profit we have before relieving losses. But in theory, when they ask us what is education tax charged on, we say it is charged on accessible profit. That is because in some literature, this word is used interchangeably. They can use accessible profit here also. But what the education tax defined it as is that what? It is the rate on the profit before relieving losses. So that is that. That is that on computation of CIT on chargeable profit basis. Any question for me before I proceed? Any question for me before I proceed?
None from my end.
Okay, good. Okay, so I'll move to the next thing. The next thing will be computation of CIT on dividend basis. What do we mean by computation of CIT on dividend basis? The Company Income Tax Act says that when the dividend declared is more than uh, the chargeable profit, then we'll compute our tax on the dividend, not on the chargeable profit. What do I mean? If we do all of this computation and our chargeable profit is, let's say, 5,000, but we look at the financial statement and the dividend declared for that period is 7,000. The law is saying instead of us to do 30% of this 5,000 to know our tax liability, we should come and do 30% of this 7,000. Do we understand? Do we understand? Hello?
Can you come again, sir? Mute
I
my
said
distance.
where the dividend declared
Okay.
is more than the chargeable profit, the law says that what? We should subject the dividend to tax in place of the chargeable profit. And I'll give an illustration that let's say we do all of this calculation and our chargeable profit is 5,000. But we look at the dividend they declared for that year and the dividend declared is 7,000. The law says we should leave the chargeable profit and calculate our tax liability on the basis of that 7,000, not the 5,000. Is it clear?
Okay.
Yeah, clear.
Okay. However, there are 4 restrictions to that order. There are four restrictions to that provision. 4 restriction. What are the restrictions? Number 1, condition number 1 that would not make us to subject dividend to tax is where 1, dividend is paid out of retained earnings. If the dividend is paid out of retained earnings, it simply means, retained earnings are earnings that has been subjected to tax earlier in the previous years, right? So if the retained earnings has been subjected to tax in the previous years, then it simply means that what? We should no longer subject the dividend to tax. We'll go and stick with our chargeable profit. What do I mean? What do I mean? So, but how do we know if the dividend is paid from retained earnings or not? I don't know, but I think the best way to go about it is first check how much is the profit made during the year. Let's assume the profit made during the year is just 1,500. You will agree with me that if they made profit of 1,005, then there is no way the dividend they are paying is coming from this profit, or only part of this dividend is coming from this profit. The remainder will be coming from their retained earnings in the absence of other information. So we'll say the dividend is being paid from retained earnings. So we'll stick with our 5,000 and we will not apply the tax rate on the dividend. Is that clear?
Yes, sir.
Number 2 is where the dividend is paid from a non-taxable income. Where the dividend is paid from a non-taxable income. Now let's even assume the net profit is 11,500, and we can say the whole dividend of 7,000 is paid from this profit. But we realize that that part of this income, there is a non-taxable income of 9,000 in it. 9,000. That means if we take out the non-taxable income from this profit, the remainder is not enough to pay the dividend. So we can say the dividend was being financed by this non-taxable income, and as such, we will not subject the dividend to tax because it is being paid from a non-taxable income. We will stick to this. Do we understand? Do we understand?
Yes, sir.
So the next one is if the dividend is paid from a franked investment income. A franked investment income is income like dividend. So if we have received maybe a dividend and that dividend is so much, that is what we are using to pay our own dividend, then we cannot subject it to tax, because remember we say on a franked investment income, the last tax will be the withholding tax they have taken on it.
Yes.
So that is that. And the last one is where it is the dividend of a real estate investment scheme. If it is the dividend of a real estate investment scheme, so where it is the dividend of a real estate investment scheme also, we will not charge CIT on dividend, rather we will just charge this on our chargeable profit. But where the dividend is not coming from any of these 4 sources, and the dividend declared is more than the chargeable profit, then we charge CIT on the dividend. The next one is CIT on turnover. CIT on turnover, it usually occurs where we have a best of judgment assessment. Maybe a company has filed their assessment now, and the tax authority is not comfortable with what they are declaring as profit. Maybe they feel like they've doctored their account and it's not reflecting what it should reflect. Then they can agree on a fair percentage that, okay, maybe 20% of your turnover will represent your profit for the year. So if that's the case, that 20% of profit is what they will now take to be the adjusted profit. Then they will do other computation and they will get their tax liability. That is what we call CIT on turnover basis. Do we understand?
Yes.
Then the last one will be minimum tax. What do we mean by minimum tax? Minimum tax is where we have minimum tax is where we have yeah, sorry.
Sorry, sir. Ẹ pẹ̀lẹ́.
Thank you. Minimum
Hmm.
tax is minimum tax is payable where a company has maybe they don't have taxable profit. We did this computation and their chargeable profit is zero or nil. They will have to pay minimum tax. Or their their computation result into loss, they will have to pay minimum tax. If it results into loss, they have to pay minimum. If they made loss, they have to pay minimum tax. Or number three is where the normal tax we have computed, this one we compute here, is lower than what the minimum tax is. You know, just like the name implies, minimum tax. That's the least amount of tax you can pay in any year. And how do we compute the minimum tax? It is 0.5% of turnover less frank investment income. Less frank investment income. It is 0.5% of turnover less frank investment income. It is 0.5% of turnover less frank investment income. However, between 2019 to 2021 accounting year or 2020 to 2022 year of assessment, the revised finance act of 2022 say any 2 years within this period, a company can use 0.25% to calculate their minimum tax just for any 2 years within this period. Though it cannot exceed this period, they can calculate their minimum tax at 0.25%. It is one of the relief government gives companies during the COVID and post-COVID era just to reduce their tax liability. However, for however, there are exemptions from minimum tax. There are three exemptions from minimum tax. Exemptions to minimum tax. Companies or situations that will not make companies to pay minimum tax are three. Number one is if it is a small company. A small company is a company with turnover of what? 0 to 25 million. 0 to 25 million. If that's where you fall into, you will not pay minimum tax. Two is companies that are engaged in agricultural or agro-allied business. Agricultural or agro-allied business. Agricultural or agro-allied business. And number three is companies in their first 4 years of operation. First 4 years of operation. Any of these three, any of these three cases, if it is applicable to a company, then they will not pay minimum tax. They will not pay minimum tax. Aside these cases, companies will have to pay minimum tax. That is that on that. So that is okay. Another thing I'll share with us is we have benefits or incentives, tax incentives for payment or for early payment of taxes, for early payment of CIT. Sorry. So early payment of taxes. When a company pays their tax liability early enough, that is within 90 days from the end of the accounting date. If they pay within 90 days from the end of the accounting date, that's 3 months from the end of the accounting date, then what do we then if it is a medium company, they will enjoy an incentive of 2% of that tax they pay. 2% of the tax they pay will be available for them as a credit against the next year tax payment. It will be available to them as a credit against the next year tax payment. But if it is a large company, they enjoy 1% bonus, 1% incentive. That is what will be available to them. So that is that on company income tax. We haven't really exhausted all of what we have there, but I think we've done enough to go into solving questions now. So should we proceed into solving question, or we call it a time?
You can solve question. I don't know of the what's her name?
It depends on if the question is something that will not take time, we can. But if it's something that will take time, we can start that in the next class. That's just my suggestion. So that we just start and
Is
finish. But if it's a short one, we can go ahead now.
Okay. Okay, no problem. Okay, let me do one illustration, then we'll continue in the next class. I don't know, have I sent the material for this CIT to you guys?
You have not, sir.
Should have spoken up. Oh. Let me quickly send it to you. So that you can follow me as I'm moving. Because if you don't follow me, before you know it, I'm gone. You just see that I've left you here. So let's just look at a short question and we call it a time. Okay. I also don't want us to spend too much time on the call this night. So let me just pick a very short question for us to joke with, then we'll call it a time. Okay, let's just look at this Mr. Danko Shinyere. Can you guys see my screen? Can you see my screen?
Yes, sir.
So
Yes.
we have Mr. Danko Chinyere, who has worked in a neighboring African country for many years, returned to Nigeria in August 2018. He incorporated a private limited liability company known as Sidan Limited, located in Lagos on October 30, 2018. Company deals in processing and packaging of plantain chips for local consumption. The directors of the company opened a business bank account with one of the leading commercial banks in November 2018. Company commenced full operation on January 2, 2019. Your firm, Adama and Co., was appointed as a tax consultant to Shidan Limited in January 2021. At the first engagement meeting with the company, discovered that the company was yet to register with the Federal Inland Revenue Service. Relevant taxes, including value-added tax, were not remitted to the FIRS. An extract of the company's first set of financial statements made up to December 31, 2020 are as follows. We have gross turnover, and we have all of this information. So we are asked to the due date for submission of audited financial statement to the tax office. Just like we said earlier, it is what? 6 months, 6 months after the end of the reporting date, after the end of the accounting period. Requirement for filing of VAT returns and remittance of VAT liability. We'll talk about that when we get to value added tax. Basis of assessment on commencement of business. We've already discussed that in our previous discussion. The income tax liability for the relevant year of assessment. That is where we are actually going. So who are we computing for? We are computing for Chidan, Abi. We are to compute for Chidan Nigeria Limited. Chidan Nigeria Limited. So we have Chidan Nigeria Limited. Okay. So for Chidan Nigeria, it's just Chidan Limited. Chidan Limited. So for Chidan Limited, we are to compute the income tax liability. Computation of income tax liability for relevant year of what will be the relevant year of assessment here? 2021 year of assessment. So just in case you don't notice, examiner has infused commencement into this question. Now, because this company commenced during the new rule regime, that's why I'm using 2021. Remember, under the new rule, for a commencement business, the first year of assessment will be the year succeeding their year of first account. And since they said they made their first account to 2020, we'll be subjecting them to tax for 2021 year of assessment. Are we getting it? But let's assume it is old rule I want to use now. For old rule, I will have to, the first year of assessment will have to be the year they commence operation. So what I'll do here is I'll just compute adjusted profit. I'll now go and do basis of assessment, split all of those years, split the profit into it before I go compute my tax liability. Don't worry, we may have to go to that also, but it's not really necessary because examiner will be testing new law. So what do? We say we start with the net profit. What is the net profit of this business? The net profit is 42,264. 42,264. So I like to work with the additional information before going to the main SOPL, because the additional information would have given us more information about what we have in the SOPL. So we'll say add disallowable expenses. What are the disallowable expenses we have? What are the expenses we have? We have one. We have donations and subscriptions include donation to Lagos Chamber of Commerce. So you may not have read the Schedule 5 of SITA, but what I'll just tell you is that when a donation is basically for a recognized or subscription is to a recognized association, that the donation is for the benefit of the general public, it will most likely be allowable. But if it is not, it will be disallowable. So Lagos Chamber of Commerce, I don't think what they would have done to that one is donation. It will most likely be subscription, and that is allowable. Motor Boat Club is not in Schedule 5 of SITA, so we'll say donations. So they made donations to Motor Boat Club. That one is not allowable. 300. Then there was donation to Polo Club. Polo Club is also not this thing. It will be disallowable. 250. Donation to political parties. Political parties are not allowable. Political parties. How much? 7,500. But that of approved national relief fund, it will be allowable. It is an approved fund, so it will be allowable. The next one is what? Allowance for doubtful debt. Allowance for doubtful debt. Because so when they just use allowance for doubtful debt, it will definitely be general nature. Allowance for doubtful debt. But you can see they've even given us the specific provision. So that means that first one is general. So allowance for doubtful debt will be what? Disallowable. I already explained that. But specific will be allowable. Bad debt written off, allowable. Miscellaneous expenses, court fines. We already said court fine is what? Is a disallowable. Fines and penalties are disallowable expenses. Exchange loss on remittances and balances. So for exchange loss will be allowable if it has been realized or if it has been incurred. It will not be allowable, it will be disallowable if it is yet to be realized or incurred. What do I mean by that? If you have an exchange loss now, you buy something in dollars and the time you want to pay, dollar has increased. You are now incurring loss on that transaction. That is a realized loss. You've already lost that money. You can't gain it back again. That one will be allowable. But you haven't paid the person, but as at the year end, dollar has appreciated in value. Now you are already anticipating loss when you settle that transaction. That one is disallowable because you haven't incurred the loss. But because they did not split it here, we'll just take it as allowable. But if they have splitted it, the one on remittances is what will be allowable. The one on balances will be what? Disallowable. Since they said
Okay.
others are allowable office expenses, we'll leave it like that. They said the director defrauded the company to the tune of 9.8 million. When we have defalcation and embezzlement, where it is done by a senior staff, it is disallowable. But if it is done by a junior staff, it is allowable. And a director is a senior staff, so it will be disallowable. Loss of fund, 9,800. The next one is debt collection and retainer fee is allowable. Land acquisition, legal and professional charges for land acquisition, it should be capitalized. It should be capitalized, not expense. Land acquisition. How much? 3,700.
7.
Then we go back to our SOPL. What do we have? Salaries and wages treated, directors remuneration treated, electricity and generator allowable, rent and rate allowable, repairs and renewals allowable, motor vehicle expense allowable, donation and subscription treated, interest and bank charges they are allowable, bad and doubtful debt treated, miscellaneous expenses treated, loss of fund. So you can see that in that loss of fund, even though the director took 9.8 million, what they actually lost is 12.8 million. So maybe it was a junior staff that took the remaining 3 million. That's why that one will be allowable. Audit fees allowable. Legal and professional treated. Then depreciation is also disallowable. Depreciation, which is 42,825. So help me add all of it. What do we have? So in this case, we don't have disallowable expenses omitted. If we have that, it would have been in the additional information. Then we go to less non-taxable income. Less non-taxable income. Profit on disposal of PPE.
Total is 68,025.
60
68,025.
68,025. Okay. So since the profit on disposal is the only non-taxable income we have, we'll deduct that and we'll now have our adjusted profit to be what? We'll have our adjusted profit to be what?
102,429.
102,429. 102,429. So after having that, we don't have loss relief. So our adjusted profit will still be the same as our accessible profit. We don't have, so after that, we don't have balancing charge, but we have capital allowance. So we'll just say less capital allowance. Less capital allowance. So we'll say capital allowance for the year was how much? The capital allowance is 30,380. So remember, now this company, is it a manufacturing or agricultural business? They said they are engaged in the business of what? They said they are engaging in the business of processing and packaging plantain chips. Processing and packaging, so more like manufacturing. So they can relieve 100%. However, if it is not manufacturing or agriculture, they can only relieve as much as 66 to 12% of their accessible profit. But even if that's the case here, 66 to 12% of this will definitely be more than this capital allowance figure we have. So what do we have? If they can relieve that, the capital allowance to be carried forward will be nil. So if we relieve this from our profit, what do we now have as our chargeable profit? Do we understand? Do we understand? Then the CIT, because their gross turnover is 860 million. 860 million. That means the CIT will be at 30%. And because the year of assessment is 2021, the EDT will be at what? At 2%. So this is 30% of what do we have here, please? What do we have here?
72,049.
72,749. So 30% of that 72,749.
72,049.
049.
749.
049, yeah.
30%, 30% of that is what? 30,
21614.
21,614.70.
70.
But the education tax will be 2% of what? Of the adjusted or accessible profit, which is 102,429. That will give us how much?
2048.5.
2048 point what?
58.
58. So since we don't have dividend here, there is no need to do taxation on dividend or check for it. And the company is in its first year of operation, so there will be no minimum tax. There will be no minimum tax. Aside that, I think that's all we need to do for that question. Is it clear?
Yes, it is.
Is it clear?
Yes, it's
Very
clear.
good.
Okay. So that will be all for tonight. You know, actually, the class is actually supposed to be for 2 hours. I'm just doing it so that I'm just doing it the way we are doing it, because I don't want to overbore us with information. I don't want information overload. And I also want it to be something we can easily assimilate. So, ladies and gentlemen, we are gradually getting into the work. So let's be bracing up for the task ahead. So that's why we'll be calling it a time in tonight's class. In tonight's class, I really
Hello.
appreciate you. I'm with you.